Okay, so today we will talk about financial ratios, which is the last accounting chapter, and then we will start time value of money. And what we're gonna do is we talk about financial statements in the previous chapter that you already studied for, and we're using this financial statements information basically to figure out the financial ratios of companies, which you probably know already, and you should know. And we're going to use those financial ratios to have an idea about the corporate performance. So remember, this is a finance class. It's all about understanding the valuation of companies. And it's not accounting, but as finance people, you should know how to read accounting information. Probably you cannot see it, but let me read these for you. So we're going to have different classes of financial ratios. Here in the first one, we see efficiency ratios. So they will give us an idea about whether this company uses assets efficiently. So here we are going to talk about asset turnover, inventory turnover ratios. Then we have profitability ratios, like operating profit margin or profit margin. They will be they will give us an idea about how profitable this company is. And then we will have decisions related to investment. And those, again, investment decisions are important for us because we will try to figure out whether those investments are good investments, whether they add value to the company. So in this case, we will talk about economic value added, market value added, or returns on capital, returns on asset, returns on equity ratios. On the right-hand side, we have the leverage ratios. So these are all about the financial structure of companies. And we will try to figure out whether those leverage ratios are optimal or not. And in those financial ratios, we will have debt ratios or interest coverage ratios or what have you. Then we will have liquidity ratios. As its name stands for, it will give us an idea about how liquid this company is. So we'll talk about current ratio, quick ratio, cash ratio. Then, of course, with all those financial decisions, liquidity and leverage decisions, we will have an idea about how fast this firm will grow by using those finances into making investments. So here we will talk about sustainable growth rate. So overall, we are trying to figure out the shareholder value. Remember, I showed you a chart like this before, and it's all about maximizing the value of companies. So we will try to figure out whether shareholder value increases or not. So this is the basic structure of what we're going to do today and next Tuesday, basically. As I said before, we're going to focus on 5 big classes of ratios. Performance, efficiency, profitability, debt, and liquidity ratios. And no matter which ratio we are talking about, looking at a number will not mean anything or will not mean much. So those ratios are good to use because they're ratios, so you can compare different companies. This is not like levels of numbers. So you can compare different companies using those ratios, but again, there are things that you should be careful about. So first, you should make sure that you're looking at how this company is doing compared to the competitors, the rivals in the same industry, or industry overall, or the market ratios. So, like basically, we are starting with the company. We are comparing the company with the rivals, like similar firms, and then the industry, and then the entire market. Of course, this is if you're making a comparison between your company and other companies, you can also have a time series analysis of your company. So in this case, you're going to look at the historical values of all the ratios and see whether they improve or not. So these are the important things to keep in mind. Another thing is that the definitions of ratios may vary from one source to another. So it's not a mistake. If you look at it, Investopedia gives return on assets as net income over total assets. Wikipedia, on the other hand, you're probably very familiar with this. It gives net income plus interest over total assets. If you look at American Express, how they calculate return on assets, they do EBIT over total assets. So these are different definitions. It doesn't mean that one is right, the other one is wrong. You should just know what the definition is. For this class, we are following the book's definition. So I don't know whether you're studying from other books, other sources, other people, whatever, but make sure that you stick with the formulas we use in the book. Okay. So the good thing with ratios is one thing I already said, it gives us a common scale. So as I said, it's not like you're comparing $1 million to like $10 million of another company, because if those companies are in different sizes, those numbers don't mean anything. Instead, you're looking at ratios, percentages. That's a good thing. Another thing is having financial ratios will enable us to look at the company with the time series information, how well the company has been doing. Or you can do peer comparison or industry or market comparisons. These are all good things about ratios. Bad things about ratios, we're using accounting numbers. And we know that accounting numbers can be manipulated. So that's one problem. If there are different accounting methods, then you will have different ratios. So you have to make sure that you're consistent with the accounting method you're using. And then another thing is, even if you're looking at the same firm, you have to make sure that there wasn't a huge structural change in the company. What it means is if there was a huge acquisition in the previous year, then the numbers will change depending on the ratio. And you cannot say, oh, this number is better, or this number is worse now. You should acknowledge that there was a huge change in the company in that year, and it might affect accounting numbers in a different way. So you have to make the adjustment if necessary. So footnotes are important. Another thing is seasonal business. So if you compare an ice cream company's July numbers to January numbers, of course things will change, because as an ice cream company, you're going to probably sell more in July. So it will look like you're doing very well in July, and in January you're not doing very well. But since this company is a seasonal business, you should compare July numbers of this year to July numbers of the previous years. You cannot compare January and July, because these are not structurally similar months, basically. The same thing goes with economic numbers. When the government institutions announce things, make sure you're reading everything correctly. Make sure they are removing the seasonality if there is any, or they can say, like for an ice cream company, I might say, oh, in the last 6 months, my ice cream sales improved. Of course it will improve. From January to July, of course it will improve. Okay, it's not success, it's natural. So make sure that you have all those things in your mind. Okay, so now let's dig into the measures. The first one we're going to start with is the corporate performance measures. Here we're going to focus on 3, market value added, economic value added, and book rates of return. Book rates of return are return on capital, return on assets, return on equity, basically. The others I'm not sure whether you're familiar with. So let's look at it. Market value added. This is something you're kind of familiar with, actually. So market value added is the difference between this part, share price times shares outstanding, and book value of equity. Do you remember what this part was? Price times numbers of shares outstanding. It's market value of equity. So basically, market value added is the difference between market value of equity and book value of equity. Where do you find the book value of equity? From the balance sheet. What is book value of equity? What's the definition of it? Huh? So it's basically how much money shareholders invested in the company, right? How many shares they bought at what price, basically. Market value of equity, on the other hand, is how investors are seeing the company and what they expect from the future of the company. So basically, market value added, if positive, it means investors are expecting more from the company compared to what they invested in the past. So this is market value added. Another thing is, another thing you're also familiar with is market to book ratio. So it's basically market value of equity over book value of equity. We are using the same variables, let's say. One is subtraction, the other one is division, that's it. So basically market value added is market value of equity minus book value of equity. Market to book ratio is market value of equity over book value of equity. So if this is positive, then this should be what? Mathematically. If this is positive, this should be higher than 1. Exactly. So they're correlated, let's say. So let's look at these two companies, ExxonMobil and Home Depot. I'm going to do something that I shouldn't do, actually, because I'm going to compare two companies from very different industries. ExxonMobil is what kind of company, do you know? Is it? Google it. Google. Can somebody Google it? There are people who are already, yeah, thank you. Exxon.
Gas company.
It's a utility company. I wanted you to Google it because I was also surprised when I first heard it, because when it says mobile, I'm thinking about like communications as well. It's a utility company, gas, energy company. Home Depot. Huh? It's exactly. It's like, I don't know, Practicar maybe. Oh, okay. So you shouldn't do this. I'm comparing two completely different companies. I'm only doing this for the sake of explaining you the ratios. So when you look at it, Exxon and Home Depot's market value added, they are completely different. For Home Depot, it is 27,000. For Exxon, it is 149,000. So it is like, how many times more? 6, for sure, 7. Yeah, like 7 times more. 6?
5.5.
5 points. Okay, it doesn't matter. It's 6. Let's just say 6. But if you look at the market to book ratios, they are very similar. Why this is the case? Huge difference in market value added. These are definitions. And market to book ratios are almost the same. How is it possible? And it has a very easy answer.
Investors' expectations are same for both.
Okay, what else?
Because it's not the same operation, the market value is a difference, so it's about the size of the numbers. The ratio doesn't take into account the size.
It's all about the size of the level of numbers, right? So if you take, I don't know, 1 million and 7 million, right? So if this is 1 million, if this is 7 million, then if you take the ratio, it's going to be 7, right? 1 million, 7 million, it's 7. Or you can take 1 and 7, right? So it's going to be 1 and 7, so the ratio will be 7. If you take the differences, one is 7 million minus 1 million, which is 6 million. The other one is 7 minus 1, which is 6. So probably ExxonMobil, it's a utility company. It has huge assets. It's a big company. So the size of it's a bigger company. So the numbers are bigger. That's why the market value added, when you take the differences, it is different. But when you take the ratios, they have the same ratios. Okay. The problems we have with market value added is a couple. One is, first of all, in the book value of equity part, it's accounting numbers, so there might be mistakes with this. But even if there's no mistakes, in the market value part, it's all about expectations. So if the expectations of the people is wrong, market value of the company will be wrong. That's the one limitation. Another limitation is that there are lots of other things that affects price other than how well the price for the company, other than how well the company is doing. So price might be affected because of a market-wide shock or because of an industry shock. Even if the company is okay, because of other things going on, like faiz lobisi, things can be affected. And then market value of equity will be distorted, let's say. And the last thing I can think of is if you are thinking about a private company, there will not be a share price, right? Because private companies are not traded by public, so it's privately owned. So private companies will not have market value of equity. So these might be the limitations with market value added. But actually, market to book ratio, similar limitations exist for market to book ratio, but it is used more since it's a ratio. So you saw here, if you look at the levels might give you wrong ideas about companies, but when you look at ratios, it might be better. So market to book ratio is used a lot in the industry. Another thing is economic value added. This is also called residual income. This is a cute little ratio, actually. What it tells you is, it tells you the difference between operating income, which comes from basically income statement. So this is net income plus interest. And I will talk about why we're adding interest later. We have income plus interest as your operating income. So how much income you generate is the first part. The second part is cost of capital times total capitalization. So what is this? Cost of capital, if you remember it, cost of capital is what investors require from you, from the company, as a return. So it is basically investors' minimum acceptable rate of return. Do you remember that? We talked about it before. Total capitalization is basically long-term debt and equity. So together, what does it give us? So here we have debt holders and equity holders, which puts the capitalization in the company, right? Debt and equity. Here, cost of capital is their minimum required rate of return together. So this part is basically how much investors are expecting to get from this company, minimum amount. This part is how much income the company generated. So the higher it is, right, if the more positive economic value added is, the better it is. Because then the company will be able to cover what investors expect to get in return and more. So let's look at this. But before that, let me talk about one more thing. Here we have return on capital. Let's quickly go over this as well. You probably remember these from accounting chapters. Then we will talk about other things later. So basically, return on capital is operating income over total capitalization. So when you're reading those ratios, okay, even if you don't have no accounting knowledge, no math knowledge, you can just read this as like this. This is income per capitalization, right? Income per capitalization. So how much income is generated for $1 investors put in the company? Okay, so again, the higher it is, it means this company is returning more income to investors compared to what they invested in the company. The higher the ratio is, the better it is. Let's now go back to this. Okay, so here we have different companies. we have operating incomes, net income plus interest, operating incomes. Here we have cost of capital, minimum required rate of return for the investors of those companies. Here we have total capitalization, which is debt plus equity. So this is capital investors put in the company. If you remember, economic value added was cost of capital times total capitalization. And this number was deducted from operating income, right? So it's also calculated for each of those companies. Then we have return on capital. And return on capital was income over capitalization. So operating income over total capitalization. So all the numbers are calculated. Now I want you to focus on two companies. Guess which one? Coca-Cola and Google. So if you look at those companies, their operating income are similar, right? It's around like 7 billion, not bad, okay? Now, the first question. Cost of capital for Coca-Cola is 5.5%. For Google, it is 12%. So investors of Coca-Cola expect at least 5.5% return. The investors of Google, on the other hand, expect at least 12% return. Why is there a difference? Why do you think investors require different returns from Coca-Cola and Google? One magic word, which starts with R. Yes, it's all about risk, right? Google is a riskier company. When you invest in a riskier company, you expect a higher return. That's Google is a tech company. Coca-Cola is, thank you, beverage, yes. Which is very similar to leverage. Now, okay. If you write a poem, okay. And it wouldn't be the most romantic poem, right? Beverage and leverage, okay. Okay, so the riskier the company is, the more return investors require. Expected returns, okay? Realized ones might be different. But your expectation is you will get more return from Google. Now, let's continue. Total capitalizations are different for those companies. So there's more debt and equity in Coca-Cola compared to Google, which is also not very surprising. Why? Huh? I don't.
People avoid risk.
It might be because Google needs less. It's a tech company. Tech companies generally requires less capital, right? It might be because of that. Look at the economic value added. Economic value added, we know it is the difference between operating income and how much investors expect in return. They're also very similar. But look at the return on capitals. It is 40 for Google. It is 20 for Coca-Cola. So twice as much for Google. So let's try to read these numbers. So for Coca-Cola, investors required a 5% return, but Coca-Cola generated a 20% return. Right? This is return on capital, like literally it is return on capital. So basically Coca-Cola returned 15% more than what investors expected. For Google, Google's investors were expecting 12%, they got 40%. So Google generated 18% more return than expected by the investors. And if you look at the relationship between economic value added and return on capital and cost of capital, basically, as investors, what we want is, we have a minimum required rate of return in our mind, but we want companies to generate more return, right? If I know that CEO can at least return the minimum amount to me, then I'm happy. But the more return he provides to me, the better I am. So compare cost of capitals and return on capitals for those companies. So for all of those companies, return on capital is less than the cost of capitals. So CEOs generated less value, less return to investors compared to what they were expecting. For FedEx, people were expecting 6.4%. They generated 5.3. The CEO, the company generated 5.3. Is that a good thing? It's not a good thing. It's a bad thing. See, economic value addeds are negative. So as you can see, the company economic value added is negative when the company generates less return to investors compared to their cost of capital, or vice versa. For those companies, investors' required returns were less than what is generated. So these are all highly valuable companies. Yes, economic value addeds are positive. So all those things are together. But just keep the minimum acceptable rate of return and return capital part in mind. What time is it? Huh? Okay. Okay, so we talked about this. Then we have return on assets and return on equity. You are familiar with those. Return on assets, it might have different definitions, but it's still income per asset. Just read ratios like this. Income per asset. So for $1 worth of assets, how many dollars of income the company generates? And this is the return on all the assets the company has. It's not just long-term debt and equity. It's basically everything the company has. Return on equity, on the other hand, it is income per equity. So this is relevant for what kind of investors, especially? Debt holders or equity holders? Return on equity is relevant for... So this is income per equity. How much income is generated for $1 worth of equity? So what kind of investor will look at this ratio more closely? Shareholders. Because I'm the equity holder, so I want to know how much income the company generates per $1 worth of equity I have. So this is good for shareholders. One little thing, so for return on assets, for instance, we use operating income, which is net income plus interest. For return on equity, we only use net income. Why do you think there's this difference? So here, this is net income plus interest over assets. Here, it is income over equity. Why do you think we have this difference in the numerator?
Interest goes to assets.
Interest goes to what kind of investors? Debt holders. For return on equity, this is the good information for equity holders. Equity holders will get net income. But the interest goes to debt holders, which is part of the asset, of course. So here we are only using net income and equity. Here we are interested in interest as well because assets is relevant information for debt holders and equity holders. And for equity holders, income is important. For debt holders, interest is important. So for return on assets or return on capital, we are looking at net income plus interest. Compared to what the investors put in the company. This one, just for equity holders though. Questions? Okay, so here you cannot see this, but this asks you to calculate return on capital for low. So basically how we're going to do this is first we need after-tax operating income. So for income information, I need to look at the income statement. So here I have net income plus after-tax interest. How am I going to calculate it? Here in the income statement, net income is the last thing. Net earnings is equal to net income. So here I have this information, 1783. Then I need to know after-tax interest. So if you look at this, I have the interest, but I don't have the after-tax interest. So how am I going to calculate after-tax interest? So net interest is 287. How am I going to calculate after-tax interest? Huh? 1 minus?
Oh,
Tau. 1 minus tax rate, right? And if you remember, we look at this income statement before when we were talking about financial statement part, and we were able to calculate the tax rate. We don't have the tax information there, but I need the tax information. So what is the tax rate? How am I going to calculate tax rate from here? We did that before.
Tax paid divided by.
Okay, tax paid income tax provision 142 divided by pre-tax earnings or taxable income 28. We had a couple of math geniuses there. So what's the number? Don't you have a calculator? It should be what, 36?
0.36.
Okay, so this is 36%. Did you understand this part? So this is how much tax you paid. This is how much taxable income you have. So from here, you can calculate the tax rate, which is 36%. So then you multiply 1 minus the tax rate with the interest. Thank you, the net interest. And here you find 181. Sorry. The other part, one more thing, average total capitalization. So for the average total capitalization is found as long-term debt and equity. Since it says average, we need to take the average of 2 years. Depending on the definition, maybe you can also use the end of year 2008 numbers as well. But here in this definition it says find the average numbers. So what am I going to do? I'm going to find the numbers first for 2008, then for 2009, and then I will average them out. So here I have the total shareholders' equity, 19,069. Then I'm going to add the long-term debt to it, 4,528, whatever. So it will give you the total capitalization for 2009. Then you're going to do the same thing for 2008. Long-term debt plus shareholders' equity. And then you will take the average of those numbers. And the last thing is taking the ratios, basically. So return on capital is operating income over total capitalization, which is 8.4%. So for $100 you put as an investor in the company generates $8 to you, $8.4 basically. It's a good number, bad number, we don't know. We need to compare it with my cost of capital, minimum required rate of return. And then here, I'm not going to go over it, and I think we're out of time anyway. But we have the how to find return on equity, and we have how to find return on assets. For return on equity, it is net income over average equity or year beginning equity. Again, income information comes from income statement. Equity is shareholders' equity. It's from the balance sheet. And let's just stop here, and we will continue on Tuesday. Okay. Any questions? Have a nice weekend then.